Today, we'll explore the top AI and robotics ETFs poised for significant returns by 2026. We'll break down their unique strategies, recent performance, costs, and help you find the perfect fit for your investment goals. Get ready to discover how smarter machines can drive your financial future. So, why choose AI and robotics ETFs? AI and robotics are not just trends, they are fundamental shifts in how the world operates. Companies like Nvidia, Microsoft, and ABB are leading this transformation. Investing in individual companies can be rewarding but risky. ETFs offer a solution by providing diversification, spreading your investment across many companies in the sector. This lowers your risk while still capturing overall growth. The AI and robotics landscape is dynamic, with constant innovation. ETFs, especially actively managed ones, have dedicated teams that continuously research and adjust portfolios. This means you benefit from their expertise without constant personal research. Many ETFs also offer global exposure, allowing you to invest in innovation worldwide. This broad diversification further enhances risk management. Finally, ETFs are liquid and transparent. They trade like stocks, allowing easy buying and selling. Their holdings are typically disclosed daily, so you always know what you own. This combination of diversification, expert management, global reach, and ease of trading makes AI and robotics ETFs a powerful tool to capitalize on these transformative technologies without excessive individual stock risk. Now, how do you choose a good ETF in this area? Choosing the right ETF requires focusing on a few key criteria. What companies they own, holdings. An ETF's strength comes from its underlying companies. Look for leaders in AI chips, Nvidia, AI software, Microsoft, Palantir, and robotics automation, Intuitive Surgical, FANUC. A good ETF will have a diversified mix across these areas. Past returns, performance. While not a guarantee, past performance offers insight. Look at 1, 3, and 5-year returns. Consistent positive returns, especially during volatile periods, indicate good management. Balance growth potential with stability. Fees, expense ratio. This is the annual percentage you pay the fund manager. Lower fees mean more of your money works for you. Aim for competitive rates, typically under 1% per year. Size and trading volume, assets under management and liquidity. Larger funds, high AUM, are generally more stable. High trading volume means easier buying and selling at fair prices. Healthy volume ensures smooth transactions. By considering these factors, you can choose an ETF that aligns with your investment strategy and long-term vision for tech investing. So, let's check our top 5 AI and robotics ETFs for 2026. Number 1. Global X Robotics and Artificial Intelligence ETF, BOTZ. As of August 2025, the Global X Robotics and Artificial Intelligence ETF, BOTZ, is trading at around $34 per share, sitting in the middle of its 12-month range after a modest summer pullback from April's highs. BOTZ is one of the most popular thematic ETFs for investors who want direct exposure to the fast-growing robotics and artificial intelligence sectors, industries that have been transforming everything from healthcare and manufacturing to autonomous vehicles and defense systems. The fund takes a global approach, investing in both US and international leaders in robotics and AI hardware and software. Some of its top holdings include Nvidia, the undisputed powerhouse in AI chips and GPU computing, Intuitive Surgical, famous for its minimally invasive robotic surgery systems, and Keyence, a Japanese leader in automation sensors and vision systems. Together, these holdings form a solid foundation that captures innovation from multiple geographies and applications. Performance-wise, BOTZ has been a story of resilience. In 2023, it surged an impressive 39%, riding the AI investment boom sparked by breakthroughs in large language models, generative AI, and automation in logistics. While 2024 brought more volatility due to macroeconomic uncertainty and interest rate hikes, BOTZ still managed a 12 to 13% gain year-to-date in early 2025, showing it can weather short-term market noise while keeping its long-term trajectory intact. One of the main draws of BOTZ is its diversification across industries within the AI ecosystem. You're not just betting on one technology, like autonomous driving, but on the broader infrastructure, from semiconductor design to industrial automation to AI-enabled medical devices. That balance makes it less vulnerable to hype cycles around a single subsector. The annual fee is 0.68%, which is higher than broad market index funds but typical for niche thematic ETFs. In return, You get targeted exposure without having to research and buy individual AI or robotic stocks. Who is BOTZ for? This ETF fits well as a long-term growth holding for investors comfortable with moderate volatility. It's not for day traders or those looking for quick flips. Rather, it's for those who see robotics and AI as megatrends likely to expand over the next decade. With AI integration accelerating in manufacturing, cloud services, and healthcare, and robotics becoming critical to offset labor shortages, BOTZ offers a way to ride that wave without having to pick winners yourself. Looking ahead, catalysts for BOTZ include expanding AI adoption in industrial automation, breakthroughs in humanoid robotics, government incentives for reshoring and automation, and ongoing demand for AI chips in data centers. If the sector continues on its projected growth path, BOTZ could remain a strong performer well into the 2030s. Number 2. ARK Artificial Intelligence and Robotics ETF. As of August 2025, the ARK Artificial Intelligence and Robotics ETF, often traded under the tickers ARKI or ARCI depending on the listing, is priced between $9.10 and $9.15 per share. This is a lean, nimble ETF with an aggressive investment mandate. Target the companies pushing the absolute frontier of artificial intelligence and robotics innovation, even if that means enduring high levels of short-term volatility. Unlike more diversified thematic ETFs, ARKI leans heavily into high-conviction bets. This means fewer holdings, but a greater focus on those the fund managers believe will redefine entire industries. Among its top positions are Tesla, whose AI-driven autonomous driving software and humanoid robot program, Optimus, are being watched closely by both tech and automotive analysts. UiPath, a leader in robotic process automation that's enabling companies to cut repetitive back-office work. Shopify, integrating AI to optimize e-commerce operations and merchant sales. And NVIDIA, the backbone of AI chip infrastructure. In terms of performance, ARKI has been a standout in 2025. By early this year, it posted a staggering one-year return of over 100%, propelled by a perfect storm of rising investor enthusiasm for AI breakthroughs, bullish earnings from top holdings, and sector-wide optimism that AI will drive the next decade of productivity gains. The rally hasn't been without turbulence. ARKI's high-growth holdings tend to swing sharply on earnings misses or regulatory headlines, but so far, momentum has outweighed the dips. The annual fee of 0.75% is on the higher end for ETFs, but that's expected for actively managed, research-intensive strategies like ARKI's. Investors are essentially paying for a curated, high-conviction portfolio that is regularly adjusted to chase emerging opportunities in AI and robotics before they hit the mainstream. Who should consider ARKI? This is not a set-and-forget investment for the faint of heart. It's designed for aggressive growth investors who understand that the potential for triple-digit returns comes with the possibility of steep pullbacks. If you're comfortable holding through volatile swings and keeping a long-term horizon, think 5 to 10 years, ARKI offers a chance to be early to the next generation of AI-driven disruptors. Looking forward, ARKI's future will likely hinge on 3 catalysts. Regulatory clarity in AI development and autonomous vehicle deployment, which could unleash further growth for Tesla and other AI leaders. Corporate adoption of AI automation tools, boosting demand for UiPath and similar enterprise AI software. Global infrastructure for AI chips and robotics manufacturing, where NVIDIA and related suppliers stand to benefit from massive capital expenditure in data centers and advanced robotics plants. If 2024 was the year ARKI proved its potential, 2025 may be the year it tests investors' conviction. Those who can stomach the ride could find themselves well rewarded if AI's projected trillion-dollar market materializes by the early 2030s. Number 3. LNG Artificial Intelligence ETF. As of August 2025, the LNG Artificial Intelligence ETF, trading under tickers AIAI or AIAG depending on the exchange, is priced at approximately $24.60 per share. This ETF takes a broad, globally diversified approach to AI investing, tracking the Robo Global Artificial Intelligence Index, a benchmark specifically designed to capture companies at the forefront of AI adoption and development across multiple industries. This isn't a concentrated, high-risk bet on a handful of tech giants. Instead, it spreads exposure across a wide range of regions and sectors, ensuring that investors can participate in AI's growth whether it's coming from Silicon Valley startups, European industrial innovators, or Asian automation specialists. Among its top holdings are NVIDIA, the undisputed leader in AI chip technology and a key enabler of everything from large language models to autonomous driving, ABB, a Swiss-Swedish powerhouse in industrial robotics and automation, Keyence, the Japanese giant in factory sensors and machine vision, and Palantir Technologies, which continues to expand its reach in AI-driven data analytics for both commercial enterprises and government agencies. This mix provides exposure not just to the brains of AI, like NVIDIA's processing power, but also to the hands that physically apply AI in real-world industrial and defense scenarios. Performance-wise, the ETF has delivered the kind of steady, compounding growth that long-term investors seek. Over the past 3 years, it's returned more than 22%, a figure that reflects resilience across different market environments. In the past 12 months alone, it's up around 27%, as of early 2025, supported by consistent demand for automation and data-driven decision-making in both developed and emerging markets. Notably, the performance is less volatile than some of the more speculative AI ETFs, making it easier for investors to hold through short-term market jitters. The annual fee sits at a competitive 0.49%, making it one of the more cost-efficient options for diversified AI exposure. That's particularly appealing for investors who want to maintain a core AI holding without paying premium active management fees. Who should consider this ETF? This ETF is ideal for investors seeking a balanced, long-term position in the AI sector, a holding that could anchor an innovation-focused portfolio rather than serve as a speculative side bet. Its global reach means you're not overexposed to the US market, and its moderate risk profile makes it suitable for investors who want growth potential without the wild swings often associated with tech stocks. Looking ahead, AI is well positioned to benefit from 3 major trends. Global industrial automation, driven by labor shortages and the need for efficiency in manufacturing. The scaling of AI-driven analytics across industries like healthcare, logistics, and defense, boosting companies like Palantir. The ongoing semiconductor arms race, which ensures companies like NVIDIA remain in high demand. For investors who want to sleep well at night, AI investment with credible long-term growth prospects, the LNG Artificial Intelligence ETF offers exactly that, a globally diversified stake in one of the defining technologies of our era. Number 4. WisdomTree Artificial Intelligence ETF. As of August 2025, the WisdomTree Artificial Intelligence ETF is trading at approximately €65.50 per share, reflecting solid year-to-date gains and growing investor confidence in its focused approach. Unlike broad AI funds that mix hardware, semiconductors, and robotics, this ETF zeroes in on AI software and automation companies, a segment of the market that is capturing an increasing share of AI-driven revenue. One of the key distinctions of this ETF is its geographic balance. While many AI funds lean heavily toward US tech giants, WisdomTree's portfolio is deliberately built for European and global diversification, offering investors exposure to opportunities across multiple regions and regulatory environments. This is particularly relevant as Europe ramps up investment in AI innovation and as AI software adoption accelerates in Asia and other emerging markets. Its top holdings include Salesforce, a global leader in customer relationship management software that has rapidly embedded AI features into its platforms through its Einstein AI engine. ServiceNow, a dominant player in enterprise workflow automation that uses AI to streamline operations for thousands of large organizations, and Palantir Technologies, whose AI-driven data analytics platforms are being deployed across governments, defense agencies, and private enterprises. Together, these holdings provide a blend of enterprise AI application exposure and long-term revenue potential from subscription-based business models. While the ETF's recent history shows promising momentum, analysts expect the growth story to accelerate over the coming months. This optimism is supported by trends such as corporate AI spending outpacing general IT budgets, rapid adoption of automation in manufacturing and logistics, and the integration of AI into nearly every major enterprise software platform. Recent earnings beats from Salesforce and ServiceNow have further fueled investor enthusiasm, helping drive inflows into the fund. The annual fee is 0.82%, which is on the higher side for ETFs but reflects the targeted and actively refined exposure. For investors who value niche focus and curated selection in a high-growth sector, this extra cost can be justified by the potential to outperform broader tech benchmarks in the long run. Who is this ETF for? The WisdomTree Artificial Intelligence ETF is designed for investors who believe the biggest AI profits will come not from building the chips, but from building the software that powers AI experiences. It's also ideal for those who want diversification beyond Silicon Valley, with meaningful allocations to Europe and global leaders in automation. However, the slightly higher fee and more concentrated sector focus mean it's best suited for those with a medium to long-term horizon and comfort with moderate volatility. Looking forward, potential growth catalysts include AI integration into SaaS platforms, which could boost recurring revenue and expand margins for top holdings. Government incentives and subsidies for AI and automation adoption in Europe and Asia. M&A activity in the AI software space, which could quickly revalue smaller holdings upward. In short, WisdomTree's Artificial Intelligence ETF offers a highly focused bet on the software side of AI's revolution, backed by global diversification and positioned to ride the wave of enterprise adoption in the years ahead. Number 5. iShares Automation and Robotics ETF. As of August 2025, the iShares Automation and Robotics ETF is trading at approximately $14.99 per share, maintaining its position as one of the most accessible and cost-effective ways to gain broad exposure to the global automation and robotics industry. This ETF is designed to capture the long-term transformation of manufacturing, logistics, healthcare, and consumer industries as robotics and automation become embedded in everyday operations worldwide. Its top holdings read like a who's who of industrial and technological excellence. FANUC, a Japanese leader in industrial robotics, continues to expand its footprint in factory automation solutions globally. Keyence, another Japanese powerhouse, dominates in precision sensors, measurement systems, and machine vision, technologies critical to smarter, faster production lines. ABB, the Swiss-Swedish industrial giant, is at the forefront of both robotics hardware and AI-driven industrial automation software. And Intuitive Surgical, known for its revolutionary Da Vinci surgical systems, represents the cutting edge of robotics in healthcare. Performance-wise, the ETF has delivered steady, reliable returns, posting a 3-year gain of around 19% as of early 2025. While that figure may seem modest compared to high-flying AI-focused ETFs, it reflects a more measured growth profile tied to the steady adoption of automation technologies rather than speculative hype cycles. This stability has made it a favorite among long-term investors who prefer predictable compounding over volatile price swings. One of the fund's biggest advantages is its low cost, an annual fee of just 0.4%. That's significantly lower than many thematic ETFs in the robotics and AI space, making it a practical core holding for cost-conscious investors. With its broad diversification across multiple sectors and geographies, the iShares Automation and Robotics ETF offers a balanced way to tap into this megatrend without concentrating risk in just a handful of companies or regions. Who should consider this ETF? This is an ideal pick for moderate-risk investors who want long-term exposure to a sector that is steadily growing regardless of short-term market cycles. Unlike niche AI funds that may be highly volatile, the automation and robotics space benefits from consistent demand, driven by structural labor shortages, reshoring of manufacturing, and the push for higher productivity in both developed and emerging economies. Looking forward, several macro forces could serve as catalysts for this ETF's continued growth. Labor force challenges in developed economies, accelerating the adoption of industrial automation. Healthcare innovation, with surgical robotics expanding into new medical fields. Global supply chain resilience, prompting more companies to automate production closer to end markets. In short, the iShares Automation and Robotics ETF offers a globally diversified, low-cost, and relatively low volatility path to participate in the robotics revolution. For investors seeking steady growth and broad exposure to industry leaders, it remains one of the most dependable long-term plays in the automation space. Choosing the right ETF depends on your financial situation, risk tolerance, and investment goals. Ask yourself. Aggressive investors might prefer ARKI, conservative investors might lean towards BOTZ, AIAI, or iShares. Remember, don't put all your money in one fund. Diversify across multiple funds or asset classes. Investing is a marathon, not a sprint. Choose a strategy you're comfortable with that aligns with your long-term financial vision. Investing in the future of technology doesn't have to be complicated. With the right ETF, you can gain exposure to cutting-edge companies and benefit from innovation. Take the first step, explore these funds, and build a portfolio aligned with tomorrow's technologies. If you have questions or want to learn more, leave a comment below. Consider subscribing for more easy investing tips. Together, let's navigate the exciting world of investing and build a brighter financial future.